All right, we'll get started. If people continue to jump on, then that'll be great. So good afternoon. Thank you for joining me. It's a beautiful day here in Willoughby. Hope you're getting some sunshine wherever you are. It's turning out to be a nice day after a crazy windy morning. So today we're going to talk about health savings account, health retirement arrangements, and flexible spending accounts, not necessarily in that order, but talk a little bit about each one of them and what they're all about, the tax purposes for those and limits on them and all sorts of stuff. So we'll talk about a few different things. Make sure my recording is going here. So I'm going to share my screen. I have a presentation that I'll walk through. We're only going to be about 30 minutes. I like to be quick and fast and furious on these things to allow people to attend the rest of their day. So I will share my screen. I will share these slides with you. There's a lot of information on these slides, so I will definitely go ahead and do that. Behind me, I have another screen for any questions that come up during the presentation. Feel free to put your questions in the Q&A box or in the chat box. I have them both behind me. And if I can answer the questions, I will. If I can't, then I will find out the answer and I'll get back to you. So let's get started. Again, we're going to talk about flexible spending accounts, health savings accounts, and health reimbursement arrangements. So we'll start with the flexible spending account. These are accounts that are basically can be used to pay for any certain out-of-pocket healthcare costs in a very tax efficient way. Any money that you put into a flexible spending account is tax-free. You do not have to pay tax on those dollars. However, you have to be eligible for a flexible spending account, meaning that you have to have an employer that offers a flexible spending account for you to save some of your money to. For 2022, for those of you who do have an employer that offers you a flexible spending account, you can contribute up to $2,850 to that account this year. We got a big $50 increase for 2022. Interestingly enough, if your spouse also has a flexible spending account at his or her employer, he or she can also contribute up to $2,850 to his or her own flexible spending account. So if you have a lot of out-of-pocket medical expenses, if you have to buy glasses every year like I do, or any other kind of out-of-pocket expenses or premiums, or I'm sorry, not premiums, co-pays, things like that. If you have those that can be paid out of the flexible spending account, it may be worthwhile if you're a married couple for both of you to max out to that, because again, that money can be used to pay for your qualified medical expenses tax-free. Employers may make contributions to your flexible spending account, but they're not required to. However, if they do make contributions, then you have to reduce yours a bit because you cannot go over $2,850, either employee money or employer money. That's the maximum for this year that can go into that account. So continuing on, your FSA dollars, they must be used to pay for qualified medical expenses. You're going to hear me say that term over and over again. When we talk about flexible spending accounts, health savings accounts, there is a list of qualified medical expenses. That list is huge. From like co-pays and things like that, to medical drugs, prescriptions, even to going to the CVS and buying Band-Aids or allergy medicines. So it's really a comprehensive list. So there is a link here that I will make sure that all of you get so that you can take a look at all the different things that it does cover, because there are things it does not cover. And you want to make sure that you understand that before you save into these types of accounts. If you're saving and saying, boy, I really want it to cover adoption expenses because I want to adopt a child, so I'm going to throw some money in here tax-free, and you go to this list and find out that it doesn't cover something like that. So I just kind of threw something out there, but you get the idea. So to use your flexible spending account, a lot of companies now just provide you with a debit card, and that debit card can be used when you go to the doctor for your copay or whatever, or you can go to CVS and use it there. And interestingly enough, if you go to Walgreens, CVS, anything like that, look at your receipts next time you go. You'll see a little FSA next to each item on the list that is something that you purchased that would have been eligible through a flexible spending account. So you can do that and either submit that receipt for reimbursement, or you use your debit card, and you just want to make sure that you keep those receipts, because if you're ever audited, you want to make sure that that flexible spending account money was used towards those qualified medical expenses. Okay. Again, if you deposit funds into that flexible spending account, you do not pay income tax on those dollars. That's the beauty of this account. You must use the money within the plan year. That's the issue with the flexible spending accounts. So you need to be aware that when you're choosing how much money to put into these things, make sure that you know approximately how much you're going to be spending, and that you don't overfund it, because you lose it at the end of the year if you do not use it. All right. Your employer may offer one of two options within, as far as money expiring, or these accounts expiring. So they can provide what's called a grace period, which is up to 2.5 months extra past the end of their plan year, that allows you to use the money up to that extra 2.5 months that's in your account. Or it may allow you to carry over up to $570 that's in your account to the following year. They don't have to offer either of these things. They can't offer both. They can offer one or the other, but they aren't required to offer either of these. So you really need to check with your employer to find out what options you do have. There were a lot of issues through 2020 when COVID started, and a lot of people stopped going to their dentists and their doctors and things like that, because they were unsure of what this whole COVID thing was looking like. So they weren't using their flexible spending account dollars. So there was some issues that they did allow employers to change their plan so that people can carry money over. And in fact, even in 2021, employers had the option to allow flexible spending account participants to roll their money over into 2022 if it was not used. So again, check with your employer, because it depends on how their plan is written. And again, very important to know, this is a use it or lose it type of account. You don't want to put money in there and not use it, and then it's gone. All right. So just be careful about how much money you put into there. So let's move on to health savings accounts. These have become really popular in the very recently. Number one, because it's a popular way for people to use this type of account to save for their future healthcare expenses. Number two, employers more and more are offering high deductible healthcare plans because it's cheaper for them, and it's less premiums for you to pay. If you're a healthy individual that doesn't go to the doctors that often, maybe having the option of getting a high deductible healthcare plan is a good option for you. So stepping back, the health savings account is a type of account that allows you to set aside pre-tax dollars. You can invest those funds, maybe, depending on your account and how much money you need to have in there, whether you can invest it or not. And you withdraw those dollars tax-free to use for, again, qualified or eligible medical expenses. So it's pre-tax upfront. You get a tax deduction for putting the money in. And if it's used for the right medical expenses that follow that large list of items that you can use it for, then it comes out tax-free. Unlike a flexible spending account, the funds in a health savings account do not expire. So I tell a lot of my clients, if you have the wherewithal to fill up your health savings account or put some money into it and leave that money in there and pay for any out-of-pocket expenses for medical stuff out of another resource, out of your savings account or whatever other tools you have, and let that health savings account grow, it can be a terrific tool for future healthcare expenses, for retirees, for long-term care situations and things like that. So it really acts like another Roth IRA when you think about it. It's tax-free money. Well, it's even better because it's tax-free money going in and tax-free coming out. It can be a very, very powerful tool to allow to grow and use down the road. To be eligible for a health savings account, because not everybody is eligible to save into one, you need to be covered by a qualified high deductible healthcare plan, which is a healthcare plan that has a deductible of at least $1,400 for individuals or of at least $2,800 for a family. So it has to be a qualified HSA qualified high deductible healthcare plan, right? If you're self-employed, you can also have a health savings account. Again, as long as you have a qualified high deductible healthcare plan that you're using for yourself. So this can include, the Instacart shoppers, or my son who's a DoorDash. It lost me for a minute. I lost it for a minute there. He's a DoorDash driver, although he's still covered under my family plan, so not a big deal. But really, for just any small business, self-employed person, they can get into a high deductible healthcare plan and use an HSA if they so choose. You don't need to have an employer or work a traditional 9-to-5 job to be eligible for a health savings account. Health savings account dollars can be used for co-payments, for co-insurance payments, for deductibles, or again, that broad list of qualified medical expenses. Typically, your healthcare insurance premiums don't fit into that. Yes, you can use this HSA money for that. They don't typically fit into that. However, the IRS does allow certain things, certain premiums that you can use your HSA dollars for. And that is for COBRA premiums. If you leave your job and you decide to continue that healthcare benefit that your employer covered for you, and you want to continue it after those, for the 18 months after you're no longer employed with them, you can use your HSA dollars to pay for those premiums. You can use your HSA dollars to pay for Medicare premiums. And we're going to talk a little bit more about Medicare in a minute. You can use those to pay for long-term care insurance coverage. And we'll talk a little bit more about how much of that you can use for that. You can also use your HSA dollars for health insurance premiums while you're on unemployment. Okay. So other requirements for HSAs, some that we've already talked about. You need to be covered under a qualified high deductible healthcare plan. That's number one. If you're not under that type of healthcare plan, you cannot save money into a health savings account. Other requirements, you cannot be a recipient of a supplemental insurance coverage, like you're covered under a high deductible healthcare plan, and then you also have your spouse's insurance that'll cover additional things above and beyond that. You can't be saved into an HSA if that's the case. You cannot be enrolled in Medicare. So if once you're enrolled in Medicare, you can no longer save to HSAs. You cannot be claimed as a dependent on another person's tax return. Okay. So if you meet the requirements of being in a qualified high deductible healthcare plan, you can obtain an account through your employer, or you can go out on your own and get it at a local bank or a credit union or something like that. A lot of different companies offer health savings accounts. Every dollar that you contribute to that health savings account reduces your taxable income because you do not pay tax on that money that goes into that account. Be aware that you cannot contribute to a flexible spending account that we just talked about a couple minutes ago if you are funding a health savings account. So the contribution limits, let's finally get to some numbers here. Maximum health savings account contribution limits for 2022, and this includes both employer and employee contributions. So again, employers may, just like the flexible spending account, they may contribute some money to your health savings account for you, but they're not required to. If they do, there's some local companies that maybe they will put $500 in your health savings account every year. If that's the case, then that is included in these limits that I'm about to tell you about. All right, so you just need to make sure that you don't over contribute each year. So for an individual who is covered by a high deductible healthcare plan, that person can save up to $3,650 into their health savings account. If it's a high deductible healthcare plan that covers a family unit, then you can contribute up to $7,300 this year. One thing that a lot of people don't know is there is a catch-up contribution if you're age 55 or older, and that's $1,000. Excuse me, I'm losing my voice. So if you are married and you both happen to be age 55 or older, you can each contribute that $1,000 catch-up contribution. There's a little bit of a hitch to that, and I'll tell you about that in a second. So let's assume my husband and I are age 55, and I'm almost there. And I know I still look like I'm 25. I get it. You're surprised, but I will be 55 next year. So when we get to that point, we can contribute our $7,300. I'm assuming we're 55 this year because the numbers increment up a little bit each year. So assume we're 55 this year. We're on my husband's healthcare plan through his employer. So he contributes the full $7,300 to his health savings account. Because it's his health savings account under his high deductible healthcare plan through his employer, he can contribute an additional $1,000 to that same health savings account because he's age 55 or older. I'm also covered under that same high deductible healthcare plan. I can go out and open a health savings account. It has to be separate under my own name to put my additional $1,000 in for the year. Okay, so total for the two of us, we can get the $9,300 in. My husband can get $8,300 in his health savings account. That money can be used for the family. It just happens to be under his name. And then I have to open up a separate one to get my $1,000 contribution put in. So I hope that makes sense. Ask questions if you need to. So let's talk about HSAs and Medicare. If you are age 65 or older, your HSA can cover the following Medicare premiums: Part A, Part B, Part D, or any Medicare Advantage plan premium. Now, most people do not have to worry about Medicare Part A premiums. If you have worked your 40 quarters in the Social Security / Medicare system, and or at least Medicare system, if you've paid in for at least 10 years, then you're eligible for a premium-free Part A. But some people do not qualify for that, and they have a premium to get covered for Part A. If that's the case, that person can use their health savings account to pay for those premiums. Premiums for Medicare supplemental policies like Medigap are not covered. You cannot pay for a Medigap policy or a supplemental policy through A or HSA. You can on Medicare Advantage plans. Why? I don't know. So you can use your health savings account to pay for Medicare premiums for the typical, like we said, the Part A, Part B, Part D. However, just realize that once you are enrolled in Medicare, you can no longer contribute to a health savings account. And there are some rules about timing around that. So just be really cautious about when you do contribute to a health savings account in the year that you're turning 65. Let's say you're turning 65 on July 1st. So the first 6 months, you're not enrolled in Medicare, and then you enroll in Medicare on July 1st. You need to be careful that your health savings account for that year, you can only contribute the pro rata amount for the first 6 months that you are not eligible or enrolled in Medicare. So you'll only be able to really contribute half for that year. So just be really careful with that. Call an expert, talk to them, ask about the rules because they're very complex and can get confusing when you get towards that Medicare age. So for health savings account funds, in order to use those for qualified long-term care insurance premiums. So if you have a long-term care policy, you can use your HSA to help fund that. However, the amount that you can use that will be tax deductible or you can withdraw tax-free out of your health savings account depends on your age. So I just told you I'm age 53. I'll be 55 at the end of next year. So in my situation, I could deduct for the year $1,690. I can take that out of my health savings account and use that towards my long-term care insurance premium. So it's most likely not going to cover all of it if I had a policy like that, but it can help pay for some of that. All right, so let's finish up with the health reimbursement arrangement. This is much less common because this is something that an employer needs to fund. They create this account, they create all the rules around it, and they fund it. This is not something that you will fund or you control whatsoever. Okay, so again, this is a type of account where employers basically set up an account so that they can reimburse you, the employee, for any qualified medical expenses up to a fixed dollar amount every year or however they design this plan, because there's so many different ways they can design it. But again, the employer, they fund this plan, they own this plan. Okay, contribution amounts, again, are set by per employee set by the employer. According to the IRS rules, when you leave an employer that has a health reimbursement arrangement, and let's say this is one that while you're employed, they will reimburse you up to $2,000 a year for certain medical expenses. And when you leave that employer, they're entitled to have what's called a 90-day runout period, which means for up to 90 days after me, the employee, leaves my job, I can submit reimbursement requests to that employer for 90 days, as long as those the requests were for medical things that happened during the time that I was employed. So some HRAs are used only for retirees, meaning we're going to build up an account for you. The employer is going to build up an account for these employees, and when they retire, then they can use that account for their medical expenses. All right. Some of these HRAs are used for current employees. Again, it just depends on how the employer designs the plan. HRAs for retirees allows that retired employee to use the funds basically in the times when they need it the most, but they can use it towards, again, for Medicare or any medical costs, any prescription drugs, some healthcare premiums, and things like that. And again, that long list of things that they can use things for. It pretty much follows the same type of qualified medical expenses, if you will. Employers, again, have the ultimate flexibility in designing this plan. They can design it to choose the eligibility requirements, who's eligible to get this type of account, which healthcare expenses are eligible, how long participants have to access these funds. They can design this plan any way they want. Employers also decide how to calculate the amount of employer-funded dollars that any retirees receive. So really, it's up to them. They can choose. The way I've seen it is Medical Mutual is a local company that offers a health reimbursement arrangement, and they put a certain percentage of an employee's income into their HRA every year while they're employed, and then it kind of builds up a fake account. It's not like there's money sitting there waiting for Mary Jane to jump in there and grab the money. It's money that they say that we promise that we will reimburse you for medical costs up to this amount for a certain period of time once you're retired. So employers can choose to do it by flat dollar amount. They can allow a spend down. They can do something like I said, where they put a certain percentage of your income into it. It just depends on how they want to design it. The whole idea of it is it's another benefit. It encourages employment longevity, which especially now, that's a big deal, right? We want to be able to keep our employees. And if there's certain benefits that we can offer to them that allow them to stick around and make our relationship a little bit more sticky, then these types of accounts are good to have. So the moral of the story today, flexible spending accounts, they can only be used by an employee if the employer offers it to them. You can't go out and get a flexible spending account on your own if your employer doesn't offer this to you. For health savings accounts, they can only be used by the taxpayer if the taxpayer is covered by a qualified, high deductible healthcare plan. These are all kind of like rule number one on these things, right? The health reimbursement arrangements, they're only available when the employer designs it and funds it. If your employer doesn't do that, then you can't get one of these things. So they're all a little bit different. They're all a little bit complex in how they work, and especially with health savings account and Medicare, and when it can be turned on and when you have to stop contributing and things like that. So they can be complex. But the good thing is these are all very good tax savings tools. We're all spending money on healthcare in one way or the other. If you're not, then you're really blessed. But there's some kind of healthcare expenses that most of us have. We're seeing doctors, we have prescriptions, whatnot, dental work, eyeglasses, all that kind of stuff. So if you're already spending that and you have one of these tools available to you, use it to the capacity that it helps you reduce your taxes, and it, can be a really good tool for that. So know and understand what you have available to you. Seek guidance if you need to, and on how to take advantage of these tools, and make sure you don't over contribute or don't contribute past certain ages, like Medicare age, when you really shouldn't be. So that's it. We're even before the typical 30 minutes. So I don't have any questions that popped up on the board. I will make sure that anybody that registered for this webinar gets a copy of the slides, because I know there's a lot of information there and I went through fairly quickly. I'll make sure that that link that shows you the list of all the qualified medical expenses for flexible spending accounts and health savings accounts is attached. And the video as well will be available. So if you have any additional questions or think of something later, please feel free to reach out to me. Thank you. Enjoy the rest of your day. Take care.